Really interesting. You say that
the
macro narrative has grown exceptionally cautious and negative. I'm interested in getting your take on events at home and what we can expect to hear from Chair Yellen in her upcoming speech. Do you think she's going to be focusing on these global events?
You know, I think she will. I don't think she's going to be overly focused on them. I think her mandate is employment and inflation, and she'll definitely, give recognition to both Greece and the Chinese stock market of late. But, really, she realizes, just as I do and a lot of traders do, that a lot of this is just noise. And right now the market is just sentiment-driven, both up and down. People are a lot more interested in price action than they are in the fundamentals, and clearly the fundamentals have not shifted a whole lot. The S&P 500 stayed in a very, very tight range for a very long time, and it doesn't take much to move that out a little bit, and this is what we have, given the Greek noise and the Chinese stock market.
So historically, as I understand it, if you have a look at the minutes, global developments haven't really had a big impact on how the Fed frames its domestic monetary policy, as you mentioned. But it does look like developments in Greece and China have forced the Fed to open up somewhat. Is the commentary warranted, or do you think the Fed is just looking for an excuse?
I don't think either. I think the Fed is being overly transparent in the whole thing. I mean, let's back up and talk about Greece. I mean, good grief, 4 years ago, they were steeped in one of the worst depressions in 50 years, matched by Peru's shining path era, the Iran-Iraq war, Soviet Union collapse, and yet we still saw green shoots around Europe until very recently. I mean, the market's given back a lot. And China, good grief, we had the Shanghai Composite opening up the year at 3,200. It rallies to 5,200 in 5 months. And the fundamentals there didn't change. It's a very liquidity-driven rally. So I think it's just very obtuse, I think, from the press in general to think that there's significant problems in China causing the market to drop when it's really just liquidity-driven. A lot more people are allowed to be trading in the markets with a link with Shanghai and Hong Kong. So all that to say, I don't think the Fed's going to give it a whole lot of credence, maybe a little bit to acknowledge it, but realizing the path forward is about interest rates here, the jobs market and inflation.
Jobless claims out today, and also, we're still digesting those FOMC minutes as well. Anything in the minutes or anything in recent commentary that's helping to shift the narrative or perhaps the thinking from within the Fed on when they'll be looking to hike rates?
That's a good question. I think the only thing I can come up with is if you look at the CME Fed futures, I mean, you can price them and basically figure out what the market is thinking in terms of odds of a rate hike. Now, they're still pricing in a rate hike in 2015. However, it's dropped a lot, down to about 19% in September and 62% by December. So that's fallen a lot, but it's still pricing in some sort of rate hike. I still believe it's going to be September, but keep in mind, full disclaimer, I thought they were going to raise in June, and I was dead wrong about that. But I do believe there's going to be a symbolic rate hike. I think the inflation picture is much bigger than what meets the eye.
Larry, it's Gaurav Sodha here. Now, the Fed has to balance a risk of raising rates, and that risk is that the economy features an event later down the track that's hard to see at the moment, might or might not happen, versus keeping rates low now, which is an immediate thing. It's visible and it's vocal. How do they balance that sort of trade-off? And isn't it more likely that they'll just keep rates low for an extended time to keep the short-term situation happy?
Yeah, I love the way you put that. I'm going to have to remember that. But, the least path to resistance would be to do nothing. But let's keep in mind, and I'm sure you'd agree, that any type of quantitative easing is really a deflective move and nothing else. And at some point, a 25 basis hike is nothing more than symbolism. I mean, they mentioned that they're going to, hike rates and then be very data dependent, which they have been. So all that to say, yes, it is much easier to do nothing. But I think Janet Yellen realizes at some point they're going to have to raise rates. And I do think that day's coming sooner than later.
And you'd have to say the market would be well prepared for that event to take place, given I guess, how often we all talk about this. Larry, I also wanted to get your insights on exactly what's happening with Greece. Things are moving really fast here. Yanis Varoufakis resigned this week, and as we understand it now, the government has been working really hard to finalise those reform proposals, to put them on the table ahead of that emergency Eurozone summit on Sunday. Now, we understand that that has happened, but is a deal likely? And what should a deal look like in your view?
You know, I don't think a deal is likely given what they've done thus far, but I've been wrong before, that's for sure. You know, I think they realize that the ECB can intervene at any point, and they will. I think they're waiting for the last minute and willing. You know, how stable is that government that's in place right now? And the fact is, when you look at the exposure of foreign banks and bondholders, it's dropped by about 80%. So the ECB has come in and taken all the liquidity away. The banks are still fragile. They'll be fragile whether a deal is struck or not. I mean, it's 50-50. So I don't think that a deal is going to be struck, because I don't think they can get their gander up enough to promote the austerity that is required. And I think the biggest problem with all that is not so much that Greeks going to have to exit and come up with a new currency a week later. The bigger problem is countries like Italy and Spain and Portugal, who are making great progress but still have huge loads of debt, and they don't want that contagion of sorts to be spreading in the periphery.
I guess the other concern, and you mentioned this as well, is with banks in Greece, they are crippled, being kept afloat by the ECB right now. What happens if we don't see movements by Sunday? Would the first sign of a Grexit come from the banks?
Probably not, only because ECB can just swallow up. I mean, short-term liquidity is going to be a big issue. It's an issue right now, but even intermediate term, I don't think so, because they're going to be forced out and forced to print a new currency basically immediately. The banks are going to be closed one way or the other if this continues in the fashion it is. So I don't think if a deal's not struck, then the banks are going to go bust. I think they're in the process of doing that anyway. But the fact that liquidity is being driven by the ECB, at least 80%, not 80%, but the exposure for foreign banks has dropped by 80%, just makes that landing a lot softer than I think most of the news reports around the world are making it out to be.
So as an investor, as a trader, a keen market observer, what is your expectations for, I guess, how all of this will unfold? And do you see it having a market impact at all?
Well, yeah, absolutely. It could have a market impact. However, I do think the impact could be a positive one. Because I think back to 3 or 4 years ago when the green shoots were sprouting in Europe while Greece was tumbling down. I think it's the same opportunity for the average investor, any investor right now. The European stocks have gotten slammed since the beginning of the year. I always promote going to where the liquidity is going, and the liquidity, by and large, for the ECB is going to Europe. So cyclical stocks that have gotten hit hard since the last 6 weeks, that's where I would allocate, or that's where I would invest for the long term right now.
All right, Larry, we'll leave it there. Really appreciate your time today. Thanks again for joining us.
Thank you, Dan.